There's a button inside every major corporation in America. A button that can instantly make the rich richer, inflate a company's stock price, and deliver massive bonuses to executives. It requires no innovation, creates no new jobs, and produces not a single new product. For 50 years, pushing this button was considered a crime, a form of market manipulation so dangerous it was blamed for helping cause the Great Depression. Today, it's not only legal, it's a central gear in the entire machine of modern capitalism. A multi-trillion-dollar engine that's quietly hollowing out the American economy from the inside. This is the story of how a criminal act became standard business practice and how the ghost of 1929 is closer than any of us think. The story begins in a place of ruin. The 1929 stock market crash wasn't just a financial event. It was a crisis of faith. The Roaring Twenties had been fueled by a culture of wild speculation, where the lines between investing and gambling had completely blurred. Corporate insiders openly manipulated their own stock prices, using company money to create a fantasy of unstoppable growth. They'd buy up their own shares, creating artificial demand that lured in unsuspecting investors, only to cash out at the top, leaving everyone else to hold the bag when the illusion shattered. This practice, known as a stock buyback, was seen for what it was, a blatant fraud. When the music stopped, the consequences were catastrophic. Companies that had spent their cash reserves propping up their stock price had nothing left to survive the downturn. They collapsed, taking the entire economy with them. The public was furious, and the government knew that for capitalism to survive, the rules had to be rewritten from the ground up. In response, President Franklin D. Roosevelt's administration enacted the Securities Exchange Act of 1934. It was a landmark piece of legislation that created the Securities and Exchange Commission, or SEC, and gave it a clear mandate to protect investors and maintain fair, orderly, and efficient markets. One of its core principles was the outlawing of market manipulation. While the law didn't use the specific term stock buyback, Rule 10b-5 made it illegal for any person or entity to make any untrue statement of a material fact or to omit to state a material fact necessary in order to make the statements made not misleading. Buying your own company's shares to deliberately inflate the price was the very definition of this. The message was clear. A company's purpose was to create real value, to build factories, invent products, and hire workers, not to play games with its stock price. For the next half-century, this principle held firm. American corporations reinvested their profits into the future. They funded massive research and development projects that led to world-changing innovations. They built infrastructure and expanded operations, creating stable, well-paying jobs. The economy grew, not because of accounting tricks, but because it was genuinely productive. This was the golden age of American industry, built on a foundation where manipulation was forbidden. But this era of stability was built on a rule that a new generation of financiers was desperate to break. The change didn't start on Wall Street, but in the quiet halls of academia. In 1970, economist Milton Friedman published a revolutionary essay arguing that the one and only social responsibility of a business is to increase its profits, and by extension, its value for shareholders. This idea, known as shareholder primacy, was a radical departure from the old model. For decades, corporations had been seen as having a responsibility to all their stakeholders, their employees, their customers, and their communities. Friedman's theory offered a powerful, liberating alternative. It told CEOs that their only job was to maximize the stock price, by any means necessary. This philosophy spread like wildfire through business schools and boardrooms. It gave corporate leaders a moral and intellectual justification for prioritizing short-term financial gains over long-term sustainable growth. The stage was set for a monumental shift, but they still needed a legal way to turn this theory into cash. The old rules against manipulation stood in their way. What they needed was a key, a loophole that would unlock the very practice that the 1934 Act had been designed to prevent. That key arrived in 1982, not with a bang, but with a whisper. During the height of the Reagan administration's push for deregulation, the SEC, under a new chairman appointed by Reagan, quietly introduced Rule 10b-18. It was a seemingly minor technical rule, a single page that barely made a ripple in the news, but its impact would be seismic. The rule created what's known as a safe harbor. It stated that if a company followed a loose set of guidelines, like limiting the volume of shares it bought on a single day, its buybacks would not be considered market manipulation. There was no act of Congress, no public debate, no national conversation. In one fell swoop, a small group of unelected regulators had effectively legalized the very practice that had been outlawed for 50 years. The floodgates were opened. What was once a crime was now just a financial strategy, blessed by the very agency created to prevent it. The quiet intellectual coup of the 1970s now had its legal weapon. The machine was now legal, and what happened next would dwarf anything the Roaring Twenties could have imagined. Before 1982, stock buybacks were a rarity, accounting for less than 5% of corporate profits. After Rule 10b-18, they exploded. It started as a trickle, then became a flood. By the late 1990s, corporations were spending over $100 billion a year buying their own shares. By the 2010s, that number had surged to over $1 trillion in a single year. The logic behind this frenzy was both simple and devastatingly effective. When a company buys back its shares, the total number of shares in circulation decreases. This automatically increases a key metric called earnings per share, or EPS, even if the company's overall profits haven't grown at all. It's the corporate equivalent of cutting a pizza into 6 slices instead of 8. Each slice is bigger, but the pizza is still the same size. But on Wall Street, perception is reality. Higher EPS makes a company look more profitable and efficient, which drives up its stock price. This created a perfect feedback loop for executives whose pay was increasingly tied to stock performance through options and awards. By spending company money on buybacks, they could directly inflate the value of their own compensation packages. It was a system that rewarded financial engineering over actual engineering. You didn't need to invent the next big thing. You just needed a clever accountant. This new reality came to a head in the 2008 financial crisis. For years, the country's biggest banks had spent billions of their profits on buybacks and dividends, enriching their shareholders and executives while taking on massive risks. When the house of cards collapsed, these same institutions, now deemed too big to fail, came begging for a taxpayer-funded bailout. The public was assured this was a one-time emergency measure to save the system. Yet what did these banks do as soon as they were back on their feet? They went right back to the buyback playbook. From 2009 to 2019, America's largest companies spent a staggering $6.3 trillion on share repurchases. More money than they spent on all of their research and development and capital investments combined. The money that could have been used to raise wages, invest in new technologies, or build a cushion for the next crisis was instead funneled directly back to shareholders. The system wasn't just rewarding this behavior, it was now entirely dependent on it. Buybacks had become the primary driver of the stock market's growth, creating an illusion of prosperity that masked a deeply troubling reality. The real scandal wasn't just the money. It was who paid the price. The human cost of this financial engineering became painfully clear in recent years. We all saw the headlines. Major tech companies, once the beacons of American innovation, announcing mass layoffs. Tens of thousands of highly skilled workers were let go, told that the company needed to become leaner and more efficient in the face of economic uncertainty. Yet at the very same time, these companies were announcing record-breaking stock buyback programs. In 2023 alone, Google's parent company, Alphabet, authorized a $70 billion buyback plan. Meta, the parent company of Facebook, announced a $40 billion plan. These are staggering sums of money that could have paid the salaries of every single laid-off employee for decades to come. The message was unmistakable. The company's stock price was more important than its people. The cash was there, but it was being used to reward investors and executives, not to invest in the workforce that built the company in the first place. This disconnect revealed the dark side of shareholder primacy. The system was no longer designed for shared prosperity. It had become an extraction machine, designed to pull as much wealth as possible from the productive economy and transfer it to the ownership class. In an attempt to address this, the government recently introduced a tiny 1% tax on stock buybacks. But for companies spending tens of billions, it's little more than a parking ticket, a minor cost of doing business that has done almost nothing to curb the addiction. So where does this all lead? We now have an economy built on a foundation of legalized manipulation, a system where corporate success is measured not by growth and innovation, but by its ability to shrink its own denominator. This has created a level of fragility we haven't seen since the 1920s. Companies are loaded with debt, often borrowed specifically to fund buybacks, leaving them with no cash reserves for a rainy day. The stock market, which we're told is the indicator of our economic health, has become a distorted reflection, propped up by trillions of dollars in self-purchases. It's no longer a measure of real value. It's a measure of how much money corporations are willing to spend on their own reflection. This creates a dangerous cycle. Because the market is now addicted to buybacks, any attempt to slow them down could trigger a massive correction. This has put governments and central banks in an impossible position. They know the system is a house of cards, but they are terrified of what will happen if they pull one out.